Welcome to this special gold market update on a major geopolitical development that could directly affect your investments. Breaking news. A ceasefire in the US-Iran conflict has just been announced and is taking effect. After weeks of escalating tensions, including strikes and disruptions in the critical Strait of Hormuz, President Donald Trump has agreed to suspend attacks on Iran for 2 weeks. This follows intense diplomatic efforts, with Pakistan playing a key facilitating role in keeping communication channels open between the US and Iran. The ceasefire is tied to Iran agreeing to the complete, immediate, and safe reopening of the Strait of Hormuz, a vital route for global oil supplies that impacts energy prices and inflation here in the United States. This pause aims to reduce immediate risks and create space for broader negotiations toward lasting stability. Early market reactions show relief. US stock futures are climbing, and oil prices are easing from recent highs. Now, as a gold analysis channel, let's talk about what this means for gold. Gold is the classic safe haven asset. During the height of the conflict, when fears rose over oil disruptions, shipping risks, and wider Middle East instability, gold attracted strong buying as investors sought protection. We saw notable rallies in gold prices as geopolitical uncertainty spiked. With this ceasefire now in place, the immediate risk premium is starting to fade. That typically puts short-term downward pressure on gold prices, as reduced fear encourages investors to move away from safe havens and back into riskier assets like stocks. We've already seen gold waver or pull back slightly on positive de-escalation signals in recent sessions. However, it's not all one way. Gold remains a powerful long-term store of value, especially in an environment of global uncertainties, inflation concerns, and central bank buying. If the ceasefire holds and brings real stability, it could support steadier economic growth and sustain demand for gold in jewelry, industry, and as a hedge, particularly from major buyers in Asia. But if talks falter or tensions return, safe haven flows could quickly push gold higher again. Pakistan helped facilitate this breakthrough, with Prime Minister Shehbaz Sharif urging the ceasefire, and Pakistani officials, including Army Chief Field Marshal Asim Munir, maintaining direct contacts with U.S. Vice President J.D. Vance, Special Envoy Steve Witkoff, and Iranian representatives. This mediation kept dialogue alive at a critical time. The coming days will be crucial to see how firmly this ceasefire holds and whether it leads to a more comprehensive agreement. For American gold investors, traders, and anyone with exposure to precious metals, this is a story to watch closely, because shifts in geopolitical risk directly move gold prices. In this 5-part series, we'll break it all down. The full background of the conflict, details of the diplomatic efforts, and, most importantly, a deeper analysis of how this ceasefire is likely to impact gold in both the short and longer term, with practical insights for your portfolio. What are your initial thoughts on this ceasefire and its potential effect on gold prices? Are you expecting a dip to buy or watching for renewed volatility? Drop your comments below. I read them and often feature viewer questions in future videos. The tensions boiled over in late February 2026 when US and Israeli strikes targeted Iranian sites, including high-level officials. Iran responded forcefully with missile and drone attacks on Israel and regional US allies. The situation quickly worsened when Iran effectively closed the Strait of Hormuz, that narrow waterway through which about 1/5 of the world's oil supply passes. This blockade disrupted global shipping, sent oil prices surging toward $110–114 per barrel, and created massive uncertainty around energy costs and inflation here in the United States. President Trump issued multiple deadlines for Iran to reopen the strait safely, warning of severe consequences, including potential strikes on Iranian energy infrastructure and power plants if the waterway remained blocked. As the weeks progressed, fears of a wider regional war grew. Shipping lines rerouted, insurance costs skyrocketed, and markets priced in higher inflation risks and supply chain disruptions. This is where gold came into play as the ultimate safe haven. During the height of the escalation, when oil spiked and headlines warned of broader conflict, gold attracted strong buying interest. Investors moved into the metal to protect against uncertainty, inflation fears, and potential economic fallout. We saw gold rally notably as the risk premium built up, typical behavior when geopolitical tensions threaten global energy flows. Pakistan emerged as an important diplomatic bridge during this period. Prime Minister Shehbaz Sharif publicly called for a 2-week ceasefire to give diplomacy time to work. He urged President Trump to extend deadlines and appealed to Iran to reopen the Strait of Hormuz as a goodwill gesture during any pause. Behind the scenes, Pakistani officials, including Army Chief Field Marshal Asim Munir, maintained direct lines of communication with the White House, including Vice President J.D. Vance and Special Envoy Steve Witkoff, as well as Iranian representatives. Islamabad helped relay proposals back and forth, keeping a channel open when direct talks were difficult. This mediation effort helped lead to the current 2-week ceasefire agreement, conditional on the safe reopening of the Strait of Hormuz. For gold traders, this background is crucial. The conflict phase drove safe haven demand higher because of the real threat to oil supplies and global stability. Now that a ceasefire is in place and that immediate risk is easing, we're seeing some of that premium unwind, which explains the recent wavering or modest pullbacks in gold prices we've discussed. However, the situation remains fluid. If the ceasefire holds and the strait reopens smoothly, it could support broader economic stability and potentially steady industrial and jewelry demand for gold longer term. But any signs that the pause is fragile could bring buyers back quickly. In Part 3, we'll focus more closely on Pakistan's full role in facilitating this breakthrough and what it means for market confidence. What do you think? Did the initial escalation justify the gold rally we saw? Or are you watching for a deeper dip now that de-escalation is underway? Share your analysis in the comments. I review them for future videos. If you're serious about gold market moves driven by geopolitics, make sure you're subscribed and hit the like button. We'll continue with clear, data-focused insights in the next part. Now let's examine Pakistan's central role in brokering this breakthrough and why it matters directly for gold market movements. As tensions peaked and President Trump issued repeated deadlines for Iran to reopen the Strait of Hormuz, Pakistan stepped in as a neutral and effective diplomatic bridge. Prime Minister Shehbaz Sharif publicly urged a 2-week ceasefire to give talks a chance, asking President Trump to extend his deadline, while calling on Iran to reopen the strait as a goodwill measure during that pause. Behind the scenes, the effort was intense. Pakistan's Army Chief Field Marshal Asim Munir maintained direct, round-the-clock contacts with U.S. Vice President J.D. Vance, Special Envoy Steve Witkoff, and Iranian officials. Islamabad served as the main channel for exchanging proposals, helping keep communication alive when direct talks were strained. This mediation helped lead to the current 2-week ceasefire agreement, conditional on Iran allowing the complete, immediate, and safe reopening of the Strait of Hormuz. Markets reacted quickly to the relief. Stocks climbed and oil prices eased as the immediate threat of wider disruption faded. For gold investors, this is the critical part. Gold performed as a classic safe haven during the escalation phase. When oil surged and fears of prolonged conflict rose, we saw notable buying interest in gold as investors sought protection against inflation risks, supply chain shocks, and general uncertainty. Prices moved higher on those geopolitical premiums. However, as diplomatic progress involving Pakistan gained traction and ceasefire signals emerged, that risk premium began to unwind. We've seen gold waver or pull back modestly in recent sessions, typical behavior when de-escalation reduces immediate fear. Spot gold has been trading around the $4,650 to $4,700 per ounce range, showing some consolidation as traders assess whether this pause will hold. The key dynamic here: lower geopolitical risk often shifts capital from safe havens like gold into riskier assets. A firmer dollar or rising yields in a relief environment can add further pressure in the short term. That said, gold's longer-term appeal remains intact. Central banks continue buying, and in an uncertain world, it serves as a reliable store of value, especially if any ceasefire proves fragile and tensions flare again. Pakistan's successful facilitation of dialogue has added a layer of stability that markets are pricing in right now. For American gold traders and investors, this means watching technical levels closely. Any breakdown in the ceasefire could quickly revive safe haven flows and push prices higher, while a smooth reopening of the strait might allow gold to find support through industrial and jewelry demand in a more stable environment. In Part 4, we'll dive even deeper into the specific short-term and longer-term effects on gold prices, with practical analysis for your portfolio. What's your take? Has Pakistan's mediation changed your outlook on gold, or are you still positioned for volatility? Share your thoughts in the comments. I review them regularly for upcoming videos. If gold market analysis tied to real-world events like this is what you follow, please like this video and subscribe so you catch every part of the series. We keep it straightforward, data-driven, and focused on actionable insights. Gold has behaved as a classic safe haven during the conflict. When strikes intensified, the Strait of Hormuz faced disruption, and oil prices surged above $110 per barrel. Investors rushed into gold for protection against inflation risks, supply shocks, and broader economic uncertainty. We saw sharp rallies, with spot gold climbing as high as around $5,400 per ounce at the peak of tensions in early March. However, as diplomatic efforts including those channeled through Pakistan, gained traction, and ceasefire signals emerged. That geopolitical risk premium started to unwind. In recent sessions, gold has been wavering and showing modest pullbacks. Spot gold has traded in the $4,650 to $4,700 per ounce range, with futures reflecting similar consolidation as markets price in reduced immediate threats. Why the short-term pressure? When fear subsides and a ceasefire takes hold, even a temporary 2-week pause, investors often rotate out of safe havens like gold and into riskier assets such as stocks. A firmer US dollar or any rebound in treasury yields in a relief rally can add further headwinds. We've already seen early signs of this dynamic. Gold easing as oil prices cooled and stock futures climbed on de-escalation hopes. That said, the picture isn't entirely bearish. Gold retains strong longer-term fundamentals. Central bank buying continues at a healthy pace, and in an environment of lingering global uncertainties, it serves as a reliable store of value. If the ceasefire leads to smoother oil flows and lower energy inflation, it could support steadier economic growth, which in turn may boost industrial and jewelry demand for gold, especially from major buyers in Asia. On the flip side, if the 2-week pause shows signs of fragility or talks stall, safe haven flows could return quickly, potentially pushing gold back toward higher levels. Key levels to watch. Support around $4,550 to $4,600, with resistance near $4,800. A sustained break above $4,800 could open the door to retesting $5,000 or beyond, while a breakdown might test deeper supports if risk sentiment improves significantly. For American investors, this means monitoring not just gold, but also correlated factors like crude oil prices, the US dollar index, and any updates from the White House or Iranian responses. The situation remains fluid. Gold isn't moving in isolation, but geopolitics like this often create tradable volatility. In the final part, we'll wrap up with the overall outlook, practical takeaways for your portfolio, and why staying informed on these events is essential for gold traders. How are you positioning in gold right now? Scaling back on the ceasefire relief, or looking for dips as a longer-term opportunity? Share your strategy in the comments. I read them and often discuss viewer ideas in follow-up videos. Here's the 5th and final part of your 5-part HeyGen video script, optimized for USA YouTube users on a gold analysis channel. It runs approximately 5 minutes at a natural analytical speaking pace, 130-140 words per minute. This conclusion summarizes the key points from the series, provides a balanced overall outlook on gold, short-term relief pressure with longer-term opportunities, includes practical takeaways for U.S. investors, and ends with a strong call to action. It connects smoothly from Part 4, deeper gold analysis, and wraps up the entire series professionally. Visual suggestions for HeyGen, gold analysis focus, recap timeline or split-screen highlights from previous parts, final gold price charts, current range, $4,650, $4,700, support resistance levels, and scenario arrows, ceasefire holds versus breaks. B-roll, positive peace imagery mixed with market tickers, gold bars, US flag, economy icons, subscription prompts, upbeat yet professional closing music. Part 5, overall outlook for gold, key takeaways and what to watch next. Welcome to the final part of our special 5-part series on the US-Iran ceasefire and its real impact on the gold market. Over the past 4 parts, we covered the breaking ceasefire news, the background of the conflict with the Strait of Hormuz disruptions, Pakistan's key diplomatic role in facilitating talks through high-level contacts, and a detailed analysis of how gold reacted as a safe haven during the escalation. Now let's bring it all together with a clear overall outlook and practical takeaways for gold investors and traders. The 2-week ceasefire, conditional on Iran reopening the Strait of Hormuz, represents a meaningful step toward de-escalation. Pakistan's mediation, including direct engagement by Prime Minister Shahbaz Sharif and Army Chief Field Marshal Asim Munir with U.S. and Iranian officials, helped keep communication channels open and contributed to this pause. Markets have shown initial relief, with oil prices easing and stocks gaining as immediate risks recede. For gold, the short-term dynamic is fairly straightforward. As geopolitical fear subsides, the safe haven premium that drove rallies earlier in the conflict is unwinding. Spot gold has been trading in the $4,650 to $4,700 per ounce range recently, with some wavering or modest pullbacks on positive ceasefire signals. This is classic behavior. When uncertainty drops, capital often flows from gold into riskier assets, and a stronger dollar or yields can add pressure. Looking longer term, gold still holds strong appeal. Central banks continue accumulating, and in a world with ongoing economic uncertainties, inflation risks, and potential fragility in any temporary ceasefire, it remains a reliable store of value. If the pause leads to smoother energy flows and lower inflation pressures, it could support steadier industrial and jewelry demand, especially from Asia. On the other hand, any breakdown in talks or renewed tensions could quickly reignite safe haven buying and push prices higher again. Key levels to watch right now. Support in the $4,550 to $4,600 area, with resistance near $4,800. A clear break above $4,800 might signal renewed upside momentum, while a deeper drop could test lower supports if risk sentiment improves significantly. U.S. investors should also monitor correlated factors like crude oil prices, the U.S. dollar index, Treasury yields, and any fresh updates from the White House or Tehran. Practical advice. In this environment, consider using dips as potential longer-term accumulation opportunities if your strategy is bullish on gold fundamentals. For shorter-term traders, volatility around ceasefire developments offers setups, but always manage risk with stop losses, given how quickly geopolitics can shift. Diversification remains key, as gold often performs well as a hedge regardless of short-term moves. In summary, this Pakistan-facilitated ceasefire is positive for regional stability and could ease some near-term pressures on gold. But the metal's longer-term role as a safe haven and inflation hedge keeps it attractive for many portfolios. The situation remains fluid, so staying informed is essential. What's your final take after this series? Are you viewing the current range as a buying opportunity on any further weakness, or staying cautious until we see how the 2 weeks play out? Share your thoughts and strategies in the comments below. I read every one and often feature smart viewer insights in future videos. If you found this gold analysis series helpful, factual, tied to real events, and focused on actionable insights, please give it a thumbs up, subscribe to the channel, and hit the notification bell so you never miss updates on gold market moves driven by geopolitics, economics, and policy. Thank you for watching all 5 parts. Let's continue navigating these markets together with clear, data-driven analysis. Stay informed, trade smart, and I'll see you in the next video. Until then, take care.